Look at your screen. Imagine a number. That number represents your total savings the day you retire. Now, imagine that number is 30% smaller. Imagine looking at your bank account and realizing you have to survive on a third less than the person sitting next to you doing the same job, just because of statistics. This is not a hypothetical. This is the reality of the gender wealth gap in 2026. For every dollar a man has in his retirement account, a woman typically has roughly 83 cents. Over a lifetime, that gap doesn't just mean a cheaper vacation or a smaller car. It means the difference between financial freedom and financial anxiety. It means the difference between retiring on your terms and working well into your 70s. We are told the narrative that the pay gap explains it all. Women earn less, so they save less. While that is a major factor, it is the tip of the iceberg. The real problem runs deeper. It is the investment gap, it is the time gap, and it is a silent financial killer called the confidence trap. Today, we are going to dismantle the excuses. We are going to look at the cold, hard math. I am going to show you why the old advice of just save 10% fails women specifically, and I am going to give you a personalized, tactical plan to close that gap before the clock runs out. Let's start with the raw data. The real math of the gap. In 2026, the gender pay gap has narrowed slightly, but it persists. On average, women earn roughly 82 cents for every dollar earned by men. Let's put that into a retirement calculation. Let's take a hypothetical example. Meet Sarah and Mike. They are both 30 years old. They both work in similar roles in marketing. They both plan to retire at 65. Mike earns a salary of $100,000 a year. He saves 10% of his income annually. That is $10,000 a year going into his 401k. He invests it in a low-cost index fund, returning an average of 7% a year. Sarah, because of the persistent wage gap and perhaps a few years out of the workforce for caregiving, earns $85,000 a year. She also saves 10%. That is $8,500 a year. Over 35 years, let's see what happens. Mike's contributions, compounded at 7%, grow to roughly $1,400,000. Sarah's contributions, compounded at the same rate, grow to roughly $1,190,000. There is a gap. Sarah has about $200,000 less than Mike. That is a massive gap, but here is where it gets terrifying. Women, on average, live 5 years longer than men. Mike retires with $1.4 million. He lives for 20 years in retirement. He can safely withdraw about $55,000 a year. Sarah retires with $1.1 million. But she lives for 25 years. She has less money, but it needs to last 5 years longer. Her safe withdrawal rate drops. She has to live on roughly $40,000 a year to not run out of money. Suddenly, the gap isn't $200,000. It is a lifestyle reduction of nearly 30%. That is the longevity penalty. You are living longer, which is a blessing, but the financial system penalizes you for it because you have less capital to start with. And we haven't even talked about the time gap. Step 1. Calculate your career interruption cost. The traditional career path is linear. You work from 22 to 65 without stopping. That model is outdated, especially for women who disproportionately take time off for caregiving, whether for children or aging parents. Every year you are out of the workforce, you lose two things. First, you lose the salary. Second, and more importantly, you lose the compound growth on that year's savings. Let's say Sarah takes 5 years off in her 30s to raise young children. She stops contributing $8,500 a year for 5 years. That is $42,500 in missed contributions. But because those years were in her 30s, that money had 30 years to grow. At 7% interest, that 5-year break costs her portfolio roughly $325,000 by retirement. $325,000 gone. vanished because of a 5-year break. So, how do we fix this? We cannot simply wish for higher wages. We have to be tactical. Step 2. The aggressive asset pivot. This is where the investment gap comes in. Studies show that women tend to be more conservative investors than men. In 2026, with financial apps and robo-advisors everywhere, many women are still choosing safe portfolios, high bonds, low stocks, or simply holding too much cash. Why? Because society teaches women to be savers, not investors. To be responsible often means don't take risks. But here is the math on risk. If Sarah invests her $8,500 a year into a safe portfolio, let's say 60% bonds, 40% stocks, averaging a 4% return. Over 35 years, she ends up with roughly $650,000. That is nearly half of Mike's total. If Sarah realizes that she is starting behind and needs to catch up, she must shift her strategy. She needs to take more risk, not less. If she invests the same amount in an aggressive portfolio, 90% stocks, 10% bonds, averaging 8% return, which is historically reasonable for stocks, her total becomes roughly $1,500,000. By simply shifting her asset allocation from safe to aggressive, Sarah closes the gap completely. She overtakes Mike's conservative total. The lesson here is counterintuitive. Because you have less capital to start with and you face a longevity penalty, you cannot afford to play it safe. You need the higher returns of the stock market to bridge the gap. Action step. Log into your 401k or brokerage account right now. Look at your asset allocation. If you are more than 10 years away from retirement, you should likely be heavily weighted in equities. If your risk tolerance survey put you in a moderate fund, you might be sabotaging your future retirement. Recalibrate. Step 3. The spousal era and career break loopholes. If you are married and taking time off for caregiving, you are not disqualified from retirement savings. In 2026, the spousal era is one of the most underutilized tools. If Sarah is not working, but Mike is working, they can file a joint tax return and contribute to an era for Sarah. Mike's income covers the contribution. This is vital. Even if you have zero income, you can still contribute the maximum amount to your own retirement account, around $7,000 in 2026, depending on inflation adjustments, as long as your spouse has earned income. Do not skip this. Every year you are out of the workforce, you must ensure your spouse is funding your IRA. It is non-negotiable. It protects your financial independence. Let's pivot to the psychology, the confidence trap. Research shows that men will apply for a job if they meet 60% of the qualifications. Women tend to apply only if they meet 100%. This bleeds into salary negotiation and investing. Women wait to feel fully educated before investing. Men often just dive in. While you are reading the 5th book on safe investing, the market has moved. Inflation has eaten your cash. In 2026, you cannot afford analysis paralysis. The cost of waiting is higher for you. If you delay investing by 5 years because you are saving up or learning, you are amplifying the gender gap. Step 4. The salary anchor strategy. We have to address the income side. The pay gap often comes down to negotiation. When you accept a job offer, that starting salary anchors your entire career earnings. Raises are percentages of that base. If you start $5,000 lower over a 30-year career with 3% annual raises, that $5,000 miss costs you over $200,000 in lost earnings and missed compounding. Here is the specific tactic. Before your next review or job interview, calculate your market replacement value. Go to salary sites. Look at the data for men in your role. Do not ask for what you think is fair based on your current salary. Ask for the market average. If you are underpaid by $10,000, getting a 5% raise on a lower base doesn't fix it. You need a market adjustment. You walk in with data. The market rate for this role is X. I am currently at Y. To align with the market and my performance, I need a raise of Z. Be blunt. Math is not rude. Math is math. Step 5. The catch-up accelerator. Once you hit age 50, the EARS allows catch-up contributions. In 2026, these limits have increased. If you are behind, and the stats say you likely are, you must max these out. The standard contribution limit for a 401k is around $23,000. The catch-up is another $7,500. Total, $30,500 a year tax-advantaged. If you are a woman in your 50s, this is your emergency brake. Let's say you are 50 and you only have $200,000 saved. You are scared. You commit to maxing out the catch-up. You put away $30,000 a year for 15 years. At 7% growth, that $200,000 plus your contributions grows to over $1 million by age 65. You can fix a decade of low savings in those final 15 years if you get aggressive. Let's summarize the gap closing plan. 1. Acknowledge the longevity penalty. You need more money than you think because you will likely live longer. 2. Audit your asset allocation. Are you too conservative? Shift to equities to capture the growth needed to close the gap. Do not fear volatility, fear running out of money. 3. Utilize spousal IRAs. If you take time off for family, your partner must fund your retirement account. It is a shared expense. 4. Negotiate base salary aggressively. A small increase today is a massive sum tomorrow. 5. Maximize catch-up contributions later in your career. The system is stacked. The stats are against you. The wage gap is real. The time gap is real. But we do not win by complaining about the system. We win by understanding the math better than the system does. You have the power to close this gap. It starts today. It starts with opening that app, checking your allocation, and making the aggressive choice. The choice that buys your freedom for those extra 5, 10, or 20 years of life. Do not be a statistic. Be the exception. Get your money right.